Welcome to another episode on the Prosper and Create Real Wealth channel. Today we're diving into a topic that may be a little boring, but it touches everyone's wallet: taxes. More specifically, we're going to navigate through 9 common tax pitfalls that can cost you dearly and share strategies to avoid them, ensuring you keep more of your hard-earned money. Let's talk about avoiding math errors and missing investment income. First off, errors on tax returns are more common than you might think, especially when it comes to investment income. You might not realize that dividends and capital gains need to be reported, even if they're reinvested. So, what's the solution? Make sure you have all your 1099 forms from your investment firms and double-check the figures. And remember, an extra pair of eyes from a tax professional or your CPA can be invaluable here. In the world of personal finance and wealth building, the story of Jane serves as a stark reminder of how a seemingly minor oversight can lead to significant financial repercussions. Jane, an ambitious and hardworking individual, had always prided herself on her meticulous approach to managing her finances. With a keen interest in growing her wealth, she often watched our channel, applying our advice on investment, savings, and tax planning. However, last tax season, amidst the chaos of balancing her demanding job and personal commitments, Jane made a simple yet critical error on her tax return. In her rush to meet the deadline, she mistakenly reported the cost basis of a stock sale. Instead of listing the actual amount she paid for the stocks, she inadvertently entered the sale price as the cost basis, effectively erasing the capital gain she was supposed to report. This oversight did not catch her eye when she reviewed her return before submission, nor did it trigger any immediate flags with the tax authorities. It wasn't until several months later that the IRS conducted a routine audit and discovered the discrepancy. The mistake led to a significant underreporting of her income and, consequently, the taxes owed. The IRS recalculated her tax liability, adding not only the unpaid taxes but also penalties and interest for the oversight. The final amount exceeded $10,000, a sum that took Jane by surprise and significantly impacted her financial well-being. She had to dip into her emergency savings, which set back her investment plans and financial goals. Jane's story is a cautionary tale that emphasizes the importance of double-checking all financial documents, especially tax returns. A single oversight, no matter how small, can have far-reaching consequences. It highlights the value of seeking professional advice or using reputable tax preparation software to avoid such costly mistakes. Her experience underscores the importance of financial education and vigilance, themes consistently reviewed here to navigate the complex world of personal finance successfully. So here's my first strategy tip. Use tax software and/or a CPA to reduce the risk of human error, and always review your 1099 forms for any income you need to report. The second common mistake is selling investments too soon. If you're selling investments within a year, you're potentially paying more in taxes than necessary. The tax rate on short-term capital gains is a lot higher than on long-term gains. So here's my next strategy tip. Hold on to your investments for over a year to benefit from lower tax rates on long-term capital gains. Plan your sales strategy to align with tax-efficient practices. The third thing that you may be doing is keeping poor records. This can lead to incorrect reporting of gains or losses. Your cost basis, or the amount you paid for an investment, is crucial for accurately reporting gains or losses. To illustrate this, let me tell you about Simon. In the bustling world of entrepreneurship, Simon found himself caught in a whirlwind of success. His innovative tech startup had taken off faster than he could have ever imagined, catapulting him into the realm of financial prosperity he had only dreamed of. Simon, however, with his laser focus on growth and innovation, neglected a crucial aspect of his newfound wealth: meticulous record keeping and tax compliance. Simon's approach to financial management was haphazard at best. Receipts were stuffed into drawers, expenses were tracked sporadically, and income was not properly documented. He believed that his success shielded him from the mundane tasks of financial oversight, trusting that a quick fix could always be found later. However, this negligence caught the attention of the IRS, as it often does. The IRS, with its rigorous checks and balances, does not overlook discrepancies lightly. Simon received a daunting letter notifying him of an impending audit. Panic set in as he realized the gravity of his situation. The disarray of his financial records was not just a minor inconvenience, but a serious legal issue. Facing potential penalties, fines, or worse, Simon sought help. He turned to a CPA recommended by a fellow entrepreneur, someone well-versed in the labyrinth of tax laws and skilled in untangling financial knots. Together, they embarked on the arduous task of reconstructing Simon's financial history, piecing together receipts, bank statements, and transaction records. It was a painstaking process, one that forced Simon to confront his previous carelessness head-on. The CPA introduced Simon to the concept of proactive wealth management, emphasizing the importance of keeping immaculate records, understanding tax obligations, and planning for the future. They implemented systems and software to streamline his financial tracking, ensuring every dollar was accounted for and every tax deadline met. As the audit loomed, Simon submitted his reconstructed financial records, holding his breath for the outcome. The process was grueling, but it was a wake-up call Simon needed. The IRS, recognizing his efforts to rectify the situation, imposed a manageable fine rather than the crippling penalties he had feared. Emerging from the ordeal, Simon had learned a valuable lesson. Wealth wasn't just about making money, it was about managing it wisely, respecting the laws and regulations, and planning for the future. He became an advocate for financial literacy among entrepreneurs, sharing his story to prevent others from falling into the same trap. Simon's journey was a testament to the idea that success requires more than just innovation and hard work. It demands responsibility and foresight in financial management. His experience served as a cautionary tale, reminding everyone in the business community that wealth is not just about accumulation, but also about preservation and wise stewardship. So for heaven's sake, maintain meticulous records of your investments, including purchase dates and amounts. Utilize financial software or consult with a professional to ensure accuracy. The fourth common mistake is forgetting to account for losses. Not all investments pan out, but losses can be used to offset gains, reducing your taxable income. This brings me to my next strategy tip. Conduct a year-end review of your portfolio to identify any losses that can be harvested to offset gains. This strategy, known as tax loss harvesting, can significantly reduce your tax liability. The fifth mistake is delaying tax strategies. Waiting until the last minute to think about taxes can lead to missed opportunities. So engage in year-round tax planning. This might mean checking in on your investments periodically and considering tax loss harvesting before the year ends. Number 6 is avoiding wash sales. Active investors need to be cautious of the wash sale rule, which disallows a tax deduction for a security sold in a wash sale. The strategy tip for this is track the dates of your sales and purchases closely. Avoid repurchasing the same or substantially identical investment within the 30-day window before or after a sale. Number 7 is not taking advantage of tax breaks. Many taxpayers miss out on valuable deductions and credits. So, familiarize yourself with the tax credits and deductions for which you may be eligible. If you have a child, for example, don't overlook the child tax credit. Consulting with a tax professional can ensure you're not leaving money on the table. And finally, number 8 is forgetting deadlines. Certain contributions and deductions must be made by December 31st, while others, like IRA contributions, can be made up until the tax filing deadline. So it will pay you to keep a calendar of key tax dates, not just for filing your return, but also for making contributions that can lower your taxable income. So, while taxes might seem daunting, being proactive, staying informed, and seeking professional advice can help you avoid common pitfalls. Remember, every dollar you save on taxes is a dollar you can invest in your future. So take the time to review your financial situation, understand the tax implications, and make informed decisions that maximize your wealth. And for those of you who haven't been paying your taxes or filing your tax returns, this would be a very good time to start doing so. The IRS has a way of showing up at the most inopportune time to help you get back on schedule while they seize your bank account and other assets. Just a word to the unwise, and I probably don't need to say it, but this is not tax, investment, or legal advice. You should always refer to licensed professionals to assist you with these important matters. So thanks again for tuning in to Prosper and Create Real Wealth. If you found this information helpful, give us a thumbs up and don't forget to subscribe for more financial insights. Until next time, keep prospering and creating real wealth.